was a 12-year bear market that began about 2011, 2012 that very much diminished the status of Canadian resource juniors. But we are about to become a sector that is critical for the survival of the global West and democracy. And this picture I have there kind of symbolizes the trap the Western world has gotten itself into, with China emerging in almost every way a dominant producer. But what's really interesting is this tiny little island, Taiwan, where over 90% of the world's chip-making capacity is concentrated, and China wants to annex Taiwan, and it's only a matter of time when that happens. And that's part of the backstory as to why the United States, with its current policies, is setting up a massive exploration boom in North America. So this is my favorites collection. Vancouver was a tremendous show. We had standing room crowds in the speaker halls, and it was packed outside. Then February, we kind of hit the wall. The problem was people had discovered gold was up. It was near $5,000. They cranked it to $5,500, where it has no business being at this stage. And inevitably, there was blowback. It crashed back. And so now we've been trading in this sideways mode, wondering, okay, what is gold going to be? Now, my favorites collection, it really didn't start growing until about the middle of last year. This bull market is only 8 months old. It has just begun. And all the companies except a couple are up, but they have so much room left to run. So the two key drivers are the United States' campaign of deglobalizing, making America front and center, dominating everything, alienating the allies, and of course their foes. They're already alienated from them. So gold is up, not because there's a bunch of gold bucks expecting fiat currency collapse, but because the nations of the world are, to a large degree, surreptitiously buying gold and stockpiling it, preparing it as a bridge away from America. And the other key thing is the whole globalization process has allowed the United States and the global West in general to let China become totally dominant in mining a lot of metals, but also processing even more and sending them back around the world. So as the United States tries to withdraw into itself, the domestic vulnerability that it has, this is a problem which it has to solve. And the alarm bells went off in 2010 when we had Rare Earth Mania 1.0, but although people talked about it, absolutely nothing has been done, which is why this crisis is involving all the other metals besides gold. This one is not going away. So one of the things that's hurt the resource juniors is the incredible upwards march in general equities driven by tech. And right now, this is a bit deceiving. It looks like it's stalled going sideways, but there's a massive rotation underway as people are sneaking out of the tech stocks, especially ones potentially impacted by AI. And there's also concern that the AI stocks themselves are way overpriced. And there is the largest foreign ownership in the American market ever. And we're now seeing the European markets and other markets elsewhere start to blossom. So there's a risk of massive withdrawal from this. But when this starts to go down, yeah, we as the juniors are going to get clobbered, at least temporarily. Now, another big headwind has been cryptocurrency. You don't need to know anything about crypto other than have faith that there's somebody stupider than you down the road who will buy your Bitcoin from you at a higher price. Well, I think crypto has kind of hit the wall. It's tracking sideways now, and they're praying that Trump uses taxpayer money to prop it up. But I think when it breaks down beyond here, I think it's going to be bad times. Meanwhile, gold is flourishing very well. Now, the problem with gold is everybody expects it to crash back to, $2,000, where, it's not very good. Now, what I've done is I've inflation adjusted gold from $400 in 1980 to the present. And gold is supposed to be an inflation hedge. And really here in 2019, it actually matched the inflation-adjusted price of gold. But now, up here at this level, it's up 229%. That's not just a double, that's a triple above the real price. And that is the big story. If there's only one thing that you need to remember from this talk, is that there is a fundamental reset in the price of gold underway. And the period in the past you need to think of is this period in the 70s when gold was released from its prison, shot to 850, crashed back to about 400, and then motored sideways while we had a tremendous discovery-focused bull market. Then there was the Bre-X slump, which was the dot-com mania, something similar to what we've been through recently. Then came the China super cycle. And then again, after that fell apart in 2013 with gold slumping, cannabis and crypto basically dominated the scene. And we had a little COVID boomlet, and then it tracked sideways again until 2024 when gold took off and almost without break, only pauses during its ascent, reached a high of 5,500 recently. Don't think about how high gold will go. The question is, where will it settle back? And I'm arguing that it's going to be somewhere between $3,000 and $4,000. And of course, when it transitions to that, it will not be fun because the market will be no bid. Those with margined accounts are going to be closed out at stink bids, and your portfolio is going to look horrific. But at $3,000 gold, that's still over 100% real price gain, and that's when this bull market really goes into overdrive, when this fear of the gold price retreat is behind us. So missing from this resource junior sector are the Gen Z and millennial audiences. They never really, when they came of age, we got the bear market. They're missing in action. We can get them back if we teach them the basis for valuing resource juniors. Is the discounted cash flow model, which most people don't understand is how a mine gets valued. And then there's what I created, the rational speculation model, which allows you to price at an earlier stage how a future outcome should be valued. And this was, of course, in 2016, one of my greatest picks, picked about 40 cents or so, Arizona Mining and Hermosa Taylor. I called it beautifully. It ended up being bought out several years later for $2 billion. So I'm going to go through the 5 companies in my session. The first one is Rockhaven, and you can see how this has taken off when I put it on the bottom fish collection and did what's something that everybody should be doing. A lot of these companies, these ounce in the ground stocks that did economic studies a while back, they were marginal at $2,000 gold. Yes, there's been some cost escalation. So I've taken the old numbers from these PEAs and done cost escalation and see what's happened at different gold prices. Now, in this case, they have a special thing that I hope they talk about later today, that Matt Turner will talk about, is they want to do up to a 10,000 ton bulk sample. It's going to cost $5-6 million bucks, but it may have $20 to $30 million worth of metal in it. So we're waiting for a permit, and this is a big thing in Canada, permits, permit delays. This is a huge problem for this sector. So how does my system work? Well, here's the DCF model repeated across different gold prices. Here's where the PEA was done, not very good. Here's where I did it at $3,000 gold. And of course, if you do, punch in something stupid like that, what people are hoping for, the numbers are so bizarre and off the scale that they're not even worth thinking about. And what this converts it into prices, assuming there's no significant future dilution. Now, in the rational speculation model, for a project at this stage with this sort of outcome, a $2 billion outcome, which is basically the halfway mark from this here, Canadian, this stock should be trading 36 to 90 cents. It's 25 cents, and the future range is potentially $3 to $5. That's before we get into crazy price levels here. So listen to the plan that they have to make this thing not just be able to put in production at the price they have, but to how to fund it without having hideous dilution. So the second company is one that I had a lot of fun with over 10 years ago when I was in discovery mode. They've got 250,000 drill holes, Spanish Mountain, and they put out an updated PEA just last July. Market didn't like it. One, the grade ended up being 0.4 grams per ton. And when you looked at the ore schedule, and this is again, technical reports, 43101, it's fantastic. You got to go look into these things. You find stuff. Here's the problem. There's a drop in grade, which is a big hole in the cash flow model. The company is doing stuff right now to fix that hole. But I've also done something else. Again, I've taken that PEA, and their base case price is down here. It's sort of not really in the money because the capex matches after tax NPV at 5%, and nobody really uses 5%. That's BS that the industry likes to use. But you move to 3,000, and this is the capex line. It's down at the bottom. The IRR is actually here. Yeah, it's 29%, which is what people want to see. And this is the range. So what I've done is I've taken the midpoint, and this is US dollars, converted it into a $1.8 billion future value. And then it's at this stage. So here's a stock, 25 cents, even with 600 million shares fully diluted. That should be $75 to $1.50. That's using $3,000 ounce gold. Never mind when you get up into the current level, like 5,000 something. So Trident Resources has not yet done an economic study, but this is a relatively new creature that was assembled early last year from 3 separate companies. And here's another important thing. Cutoff grade. They updated the resource estimate for 4 of the deposits that are in this collection of projects that they've consolidated in the Larange Gold Belt. And they end up with 2 million ounces of just over a gram per ton. That's actually in the money. So a lot of these systems that were always these marginal deposits in the past, you have to rethink them in the context of today's price. And again, use $3,000 gold, not $5,000 gold, because if we end up with circumstances where 5,000 plus is the new long-term reality, well, then the upside is even bigger. And right now they're working on the old contact mine that Cameco operated, didn't only mine part of it, and they're busy delineating this and going to show us that this thing right in the middle of infrastructure is worth developing. And again, here, if I take a $2 billion outcome as a future value, right now this is it's fairly valued. You can see in here 234 to 469 is fair value. It's like 334 yesterday, and but the future price is up here in this range, way down here. So this is why potentially a 10-bagger, 5 to 10-bagger coming out of this company, simply because the market starts to accept that $3,000 plus gold is the new reality. Now, PJX Resources is a discovery exploration junior, and discovery exploration really kind of has not been the fad for the last 20 years. 2000s were super cycle, demonstrating old deposits were in the money as a result of new prices. And so people kind of forgot what an S-curve is. An S-curve is during the discovery frenzy when you don't know the limits of the size of the deposit, but you realize it's big. The market, perversely, price reaches a peak valuation that ends up being what it's worth at the end of the day. Not in dollar per share terms, but in total absolute, $1 billion or whatever. These guys are, John Keating's PGX is hunting for Sullivan 2. A smaller version would be worth $2 billion. Sullivan 2 itself would be worth $5 to $10 billion. So right now it's at discovery. They've worked for a couple of years here. They've haven't yet hit the discovery hole. But this is a stock where it could go into S-curve territory. And here you can see S-curve, like right now, fair value is sort of 8 to 19 cents. But then if you switch to discovery stage, you're talking you can go as high as $6. So this is what we're in this game for, is these discovery exploration plays. The other 3 are largely feasibility demonstration type plays. So again, this next cycle will have both the feasibility demonstration plays, rethinking existing systems in a much higher real gold price, but also looking for new discoveries. We're going to have the best of both worlds happening. And here you can see sort of a shot. The big thing that came out last year was this new target that the forest fires had burned enough away. They found an old adit, and John will tell us more. But this is going to be the drill focus this year. And you can sort of see this is the smoking gun. The source of this classic Sullivan 1 rock has not yet been found. When they find it, and based on the context that they built, this is a huge system, might even rival Sullivan 1. So just switching to the problem America has right now. Concentration of endowment in a certain metal has been a problem in the world. We have 3 examples here. The first is rare earths in China, which China dominates through Bayan Obo, an absolute monster deposit. Then there's nickel in Indonesia, basically bankrolled by China, which has 64% of global supply. And there's also uranium, Kazakhstan, which ruined our uranium bull cycle because it came out of nowhere and became the dominant supplier, and who knows how much more that they can end up supplying. Now, uranium, this was the consequence of this happening, but with changes underway, it's now actually at a level where it's worthwhile exploring for uranium deposits in secure jurisdictions such as Canada and the United States. And the problem with globalization is that who cares about this? It means our metals are cheap. Our input costs are low. We like that. That's good. But globalization is coming to an end. So niobium, which is one of the key metal for NioBay metals, this has been a dog thanks to this huge supplier, Brazil. It dominates. It's got 93% of it. Tungsten is concentrated in China. 80+%. This is globalization at work. Everybody's happy. Arasha adds new supply whenever it's needed by the steel makers. But then you suddenly have tungsten. It's up at $1,800 per MTU from being along here, preventing anybody from producing anything else. And that's the big story of globalization. It concentrates metal supply in the lowest cost, richest jurisdiction, and nobody else can compete. And some of these jurisdictions are subsidized by the state. This has created this huge pickle. So here's NioBay. You know, it's had a big run here, and that's where I was all over it. They have this deposit. It was found here in the 60s. It was actually taken to an economic study. But NioBay was also found. It's farther south. It was developed. And Arasha was found. And this is Arasha, Brazil, coming on stream. Now, they're outside the French River watershed, which is important because this is a very, very critical watershed for the Moose Cree First Nation. But that doesn't seem to really bother or concern people in the first Moose Cree First Nation. They think everything is the watershed. So they did a PEA in 2020. cost escalated at 30%. They had 3 scenarios, and they ended up underground, combined underground, open pit, and just open pit. Obviously, right now, only underground is under consideration. So I've done the numbers, and I've discovered, well, their old base case, the current Brazil price, it doesn't work. It needs $60 a kilo. And we need a third major supplier that's in a secure jurisdiction because Brazil is a huge single point of failure risk. If something goes wrong in Brazil, say Jair Bolsonaro makes a comeback and the country erupts in civil war, 85% of niobium supply goes offline. The steel industry that needs niobium as a strengthening alloy, it's going to be in serious trouble. So I've done this year, used this. I said off-takers will do a $60 a kilo price, and that makes the outcome worth 1.2 billion Canadian. Here's the fair value range. They had to do a huge dilutionary financing, so the big $10, $15 prices I used to dream about are not there anymore. The future price is in this $4 to $5 range. Now, there's a problem with this project, and this is because Trudeau sold Canada down the river when he signed Canada onto UNDRIP, which makes sense for countries that have squashed their Indigenous people into tiny corners of their country, but not when they claim not just the entire country, but 4 times the size of the country through overlapping claims. And this has contributed to Canada, despite being the second largest country in the world, to being a real piker in terms of raw material supply. This has to change. The attitude that UNDRIP has created is that this land is the land of the First Nations, 3% of the population, and everybody else is a zero. You do what we want to do. And there has to be pushback on that. So America, biggest economy, 26%. Canada in 10th place. What's happening with gold in that is people are accepting you can't deal with America. You have to sort of work around it. That's not going to change. Here's America's vulnerability. 17% of its GDP is in goods. The rest is in services. That's GDP. Same thing on employment. Only 16% is actually making stuff. The rest is just whatever, doing things. This is a vulnerability to reshore so that America makes more and becomes self-sufficient. When it becomes alienated from the rest of the world, it really has to push for developing raw material supply. And I mentioned earlier, New York Times finally had a full-page article on this vulnerability. We've known about this for more than a decade. Nothing's been done about it. If China annexes Taiwan, I'm pretty sure those chip factories will be under Chinese control, and then those super high capacity chips that NVIDIA makes is not going to be being shipped to America anymore. So this is a serious ticking time bomb. I don't know how they will fix it, but if China does annex Taiwan, that is going to be a very interesting moment, and I think it will cause gold to do that crazy stuff of chasing towards 10,000. And here is the basis of America's problem. The red is Russia and China supply as a percentage of total supply. The blue is America, the largest economy, 26% of GDP, and yet it supplies only a fraction of most of the metals needed. Now, obviously, when you don't makes a lot of stuff, you don't need a lot of raw material, so you've been importing it. But if the whole import-export globalized concept collapses, they're going to have to make a lot more stuff, and they may not be able to get their inputs. So reshoring raw material supply is the big story, and it's not going to be a choice for the United States. They're going to have to do it. And Canada needs to be part of it, because if it's lagging, it's going to, the United States will come through on its threat. Yeah, you're going to be part of us. We'll tell the First Nations you're just like other Canadians are slaves, and we're going to develop these resources. So one final comment, the PDAC curse. I observed it back in the 2000s that everything would be great during the January effect. PDAC would happen. We'd all celebrate, have a good time. And then the market would tank, basically understood as the average traded price of TSX Venture Resource Juniors. This is like unprecedented. I've never seen anything like that. Is it going to go to the next level in the next 3-4 months? Or are we going to have the PDAC curse take this all down again? This is happening because this bull market is still concentrated. It has not yet spread sideways, like with many of these companies here. The market still doesn't quite understand what's happening. I would not be surprised if this chart, a year from now, the scale up over here is way off the chart. So thank you very much. Go to my Substack, subscribe. It's only $10 a month or $100 a year. That's the new platform I have for the favorites collection, the KRO Club. It's still open at $900 until March 5th. Then we shut it down for a while and relaunch it at $2,000. Thank you.